Okay, the last thing we have to talk about in this chapter is notes receivable. And this is something that is more formal than accounts receivable. So a couple terms. The person who's borrowing the money is called the maker of the note. So this is the debtor, the person who owes. And so the maker signs a note, which is essentially an IOU. So the person that is receiving the note is the one who lent the money, and the person who makes the IOU is the person who owes the money. And this note will specify several things that the two parties have agreed on. So it'll have an interest rate and an interest period, and generally see rates in annual terms, but we'll also see that this is for 90 days or 6 months or something like that. And that date, that interest period, will determine the maturity date and the amount of interest that the person owes. So then when the note matures, so when it comes due, on that maturity date, the maker, the maker pays the principal, so the original amount owed, plus interest. So it's not like they're late during that time period, and then once it's due, then they have to pay back the entire principal plus the interest. That's how a note works. So there's really two things we have to figure out for a note, and then the journal entries are pretty easy. The first thing we have to figure out is the interest. And you generally see this in either days or months. The interest amount, so the total interest due, is always going to be the principal times the interest rate. That will give you the annual amount, and then I'll say times the time. So the number of months over 12, or the number of days over 360. And yes, I know that a year has 365 days, but in accounting we use 360 because then you get nice even fractions, because these are almost always 30 days, 60 days, 90 days, 120 days, and so then you get nice even fractions. So let's say somebody borrowed $80,000 at 5% interest, and it's a 3-month note. Pretend that says month. So then you would just take the $80,000, the principal, times 5%, and that would give you the annual amount, times 3 over 12, which is 0.25. The other way, sometimes you see it as, say, a 90-day note, and so then you would just take 80,000 times 0.05 times 90 over 360, which is also 0.25. The other way you could look at this is 80,000 times 0.05. I think that gives you 4,000. And they only had it, that would be if it was for a whole year, right? So these right here, the annual would be 4,000. But they only had it for a quarter of a year. So we get $1,000 is the total interest paid. If they borrowed this for a whole year, they would have to pay $40,000 in interest, but they only had it for 1/4 of the year, 3/12 of the year, so they pay $1,000 interest total. There's another method I'm going to show you. This is the way the book does it here. And this one might seem long, but when we get to something a little bit later, I think you'll see where this one has its... it's really the same thing, but take the principal. It really is the same thing. It's just a slightly different version of it. Times the interest percent. And that gives you the annual interest, okay? And then divide that by 12 to get monthly interest, and then take that times the number of months that you have it. So in this case, I'd take 80,000 times 0.05, and I get 4,000 would be my annual interest, divided by 12. So the interest per month is 333.333. I have it for 3 months, and that equals 1,000. Sometimes you have to do a little rounding, which up here you hardly ever have to do that. You generally get nice even numbers there. Or 80,000 times 0.05 gives me annual interest of 4,000 divided by 360 gives me interest, a daily interest rate of 11.1111 per day. I have it for 90 days. That equals 1,000. So you just take that annual interest and turn it into a per month or per day, and then take that times the number of days you have it. So I'm going to stick with this method, and when I get to the end, you'll see why. But most of the time, you can get to that same number a shorter way. But just to keep it consistent, I'm going to go with this. So that's how we figure out the interest. The other thing we have to figure out is the maturity date. Now, this requires that you know how many days are in each month, and if you don't know that, you're going to have to teach yourself, I guess. But that is kind of critical here, because if it's like, okay, so let's say on 11/17 I issued a 90-day 6% note for 20,000. If it's at a 3-month note, then I could just say November, December, January, February, it's due February 17th. But if it says 90 days, I can't just do that. And it's not going to come out to February 17th. So this is how I do it. Okay, I say there's 90 days to start with on this note. So I start with 90 days. How many of those days am I going to use up in November? So November has 30 days, and I issued this on the 17th. So 30 minus 17 means I'm going to use up 13 of those 90 days in the month of November. So at the end of November, there are 77 days remaining on this note. In December, I'm going to use up 31 of those days, because there's 31 days in December. So at the end of December, there are 46 days remaining on this note. In January, I'm going to use up another 31, because there's 31 days in January. So that means at the end of January, there are 15 days remaining. So this note is due on February 15th. Again, different students have told me different ways they figure it out, as long as you come up with February 15th. But we can't just say 3 months from now, because when we're going days, because different months have different number of days in them. As another quick example, if this was a 120-day note, again in November, I'm going to use up 13 of those days, right? 30 days in November minus the 17th when I issued it. So there are, at the end of November, 107 days remaining. I'm going to use up 31 of those in December. So at the end of December, there are 76 days remaining. In January, I'm going to use up another 31. So at the end of January, there are 45 days remaining. In February, I'm going to use up 28. Don't worry about leap years. We're not going to get into that. So that means there are 17 days remaining. So this is due on March 17th if it's a 120-day note. So that's how I do it. I know there are other ways to do it, but this is the way I find I am least likely to make a mistake. Okay, so I'm gonna skip over to this one. This one's just some practice on interest rates, but that's the same process that I'll just do the first one there for you. Note 1. So I've got the principal of 30,000 times the interest rate of 4%, so times 0.04. That gives me annual interest of 1,200. Annual. I'm going to divide that by 12. So I get $100 per month is my monthly interest rate. I have this for 3 months, so my total interest is $300. I'll just do number 2 since that's in days too. So number 2, I've got 8,000 as the principal times 5% interest means my annual interest, if I borrowed this for a whole year, my interest would be $400, but I don't have it for a whole year. So I'm going to divide that by 360, and I get a rate of 1.111 per day is my interest. I have this for 180 days, so my total interest due is 200. Or you could take 180 over 360 and turn that into a fraction or a decimal and take that times your amount. So that's how we do those, guys. Now I want to show you the journal entries for these. So in this one, this bank is lending money to Samantha Michael, $90,000, 60-day, 6% note. So journalize the lending of the money. So that's the easy part, really. So here for number 1, I'm going to, on June 6th, I debit notes receivable, Samantha Michael, for the principal amount, which is $90,000. And then I credit cash, because that's what I gave her, $90,000. So that part's pretty easy. Now, to collect it at the end of it, we have to figure out how much interest she owes and when it's due. So let's do the date first. It's a 60-day note. And we issued it on June 6th. So in June, there's 30 days in June, and we issued this on the 6th. So I'm using up 24 days of the note in June. So by the end of June, there are 36 days remaining on this note. In July, I'm going to use 31 of those. So that leaves 5 left. So it's due on August 5th. And then we can do our interest. So our let's just do that. So our interest will be the principal of $90,000 times 6%. So I get annual interest of $5,400 if I had it for the whole year. But this is in days, so I'm going to divide that by 360. And I get an interest rate of $15 per day. And I have this for 60 days. So that is $900 total interest. So the second part says, journalize this and specify the date. So on August 5th, she's going to pay me back. So I'm going to get cash because she's paying me back. And she has to pay me the $90,000 in principal plus the $900 in interest. So I should be getting $90,900 in cash. I credit the notes receivable to show that she doesn't owe me that anymore. Yes, Michael. For the amount that I put in. So I put $90,000 into notes receivable, so that's what has to come out of notes receivable. And the difference, the $900, goes to interest revenue. Okay? And let's see. I have 2 more here that I want to show you. On December 1st, we accepted a note in exchange for an accounts receivable. So instead of giving them cash, what we're really doing is transferring it from accounts receivable to their notes receivable. So what happened is, when their accounts receivable came due, they didn't have the money. So they asked me for extra time. And so I said, okay, I'll give you 120 days, but now I'm going to charge you interest. And so this is how this one works. So let's go ahead and figure out the due date and the interest before we get to the journal entries. So it's a 120-day note. And we are issued on December 1st. So there's 31 days in December, and we issued on the 1st. So I'm using up 30 days in December. Okay? So at the end of December, there are 90 days left. In January, I'm going to use 31 of those. So at the end of January, there are 59 days left. In February, I will use 28 of those. So that means there are 31 days left, so it's due on March 31st is the maturity date. And then let's figure out our interest over here too. So it's $17,000 is the principal times 0.06 means the annual interest would be $1,020, but I don't have it for the whole year. Now you can, you could probably do this different, but I'll show you what. Well, just bear with me here. Sorry. So I'm going to divide that by 360, and so I get a daily interest rate of 2.8333 per day. Okay. And I have this note for a total of 120 days, so the total interest is $340. Okay, so that means when it comes due, they're going to pay me the $17,000 plus $340 in interest. So let's do the note first, and then I'll kind of show you what I got here. So I'm going to scoot you over there. So requirement 1 says journalize the transaction on December 1st when I moved it from accounts receivable to notes receivable. So all I'm going to do is debit notes receivable J. Peterman for the $17,000, and I credit accounts receivable J. Peterman for the $17,000. Okay, so I've moved it from accounts receivable to notes receivable, and I'm no longer actively trying to collect it, and it's going to sit here for 120 days. Now what happens though is on December 31st, I'm closing out my books and I'm doing my adjusting entries. And the fact is the total interest I've earned is $340. But some of that, let's pretend like this is 2015, okay? They're going to pay me in March of 2016. So that means of that interest, some of it was earned in 2015. And some of it was earned in 2016. And because I use accrual-based accounting, I need to count what was earned in 2015. I need to record that as revenue in 2015, even though I'm not going to receive the money until next March. And this is why I like it when you split it by days, because then you can just say, all right, of this, how much of it was in 2015 and how much of it was in 2016. So I can see right here that I used 30 days in 2015, and the other 90 days of the note is in 2016. So then I say, all right, 30 days, here's my daily rate. So I earned interest for 30 days in 2015 at a rate of 2.8333 per day. So that's $85 here. And then the other 90 days times 2.83333 is 255, which is how much interest I've earned in 2016. So the customer doesn't see this, but we need to record $85 of the revenue in 2015 in the adjusting entries. So that's here. So the second one is my adjusting entry on December 31st. This one was on 6/1. I'm going to record, it's going to go into an account called interest receivable, because this is money that's coming, but I go ahead and count the interest revenue right now, and that's for the 85. This is very similar to some of the adjusting entries we did back in Chapter 2, where we had like the payroll that we kind of had to split. Part of it was in this week and part of, 2 days here and the 3 days is later on, that kind of thing. So it's the same principle if you remember that one. Now I'm going to record the collection. So on March 31st, 2016, I'm going to record that. So the cash that I'm going to receive, they're going to pay me the the principal plus the total interest. So they're going to pay me $17,340. I'm going to credit notes receivable to show that they don't owe that anymore. And we put $17,000 into notes payable, so that's what we need to take out of notes payable. Now, I can't count the whole $340 as revenue because I already counted 85 of that. So I'm going to pull what I had set aside to this receivable. So I have now received that. So I'm going to credit interest receivable for the 85, and then the other 255 is the revenue that I earned this year. So I only have to do that when the note crosses over my fiscal year, but that's fairly likely unless everybody pays in the same year. So I'm just splitting that total interest, and I'm counting some of it as revenue this year, some of it as revenue next year. The customer doesn't see that, though. They just pay the whole thing at the maturity date. And there's one more thing I want to show you here. This is when a company doesn't pay on a note, okay? So on this one, the note was dishonored, and they defaulted on the loan. So when they default on the loan, what I do is I move it from notes receivable back to accounts receivable, and actively try to collect that money again. But the fact is, now they owe me the original principal plus the interest. So that's how much I put into accounts receivable. So in this one, we had $24,000 was the principal at 3%, which is $720 would be the annual interest. Now you can see they had it for 6 months, so you could just split that in half, or if we just keep with the way we've been doing it, I divide that by 12, and so the interest is $60 per month. They've had it for 6 months, so the total interest is $360, which you can see is half of the annual because they had it for half a year. And so now I'm going to debit accounts receivable, L. Summers, and see now they owe me the $24,000 plus the interest. So $24,360 is how much I'm putting in accounts receivable, and then I will credit notes receivable because I moved it out of there, L. Summers. That'll be for the principal, the $24,000. That's how much I had put in to notes receivable, so that's how much I take out. And the $360 interest, this is where I think it seems a little weird, but I'm going to go ahead and call that interest revenue because I earned it now. This is when it was due to me. And again, we use accrual-based accounting, so we record things when they were earned, not when we got paid for them. So even though I haven't been paid yet, the fact is I earned that, and so I count that as revenue right now. So those are the journal entries for the notes receivable. Once you've figured out the due date and the interest, the journal entries aren't too tough unless, like I said, you got to accrue it at the end of the year. So there's chapter 9.